There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.
Hi everyone, today our topic for the radio show is stock charts and technical analysis and all of the things that traders use to trade the market. A lot of people make the assumption that if they learn to read stock charts or learn about candlesticks or learn about technical analysis, then they know how to trade. And that's just not true. Trading is a process by which you use stock charts, technical analysis, indicators, and candlesticks to evaluate a stock, to determine what trading style would be best to use, to determine when to enter and when to exit, how much risk you're going to take, and where you're going to put stop losses and where you're going to exit the stock because it will retrace or correct or do something against your trade. Trading is a completely different thing than technical analysis. Technical analysis is just one small part of a trading process. There are several steps to a trading process, and learning to read stock charts and understanding candlesticks and technical analysis and indicators is just part of that. So don't assume that because you learn a little bit about technical analysis that now you're ready to trade. There's all kinds of other aspects such as trade management, how to calculate your risk, how to calculate how many points to gain, whether you should use a swing style trade, a position style trade, day trade, option, all of that factors in. So there's a lot of things that involve a trading process. But today let's talk about technical analysis and stock charts. Technical analysis started many, many years ago when Charles Dow wrote his Dow theory, and he developed the concept that the market moved in waves, and he drew a line where it showed that the smart money or the institutions bought first, and then there was a little dip, and then the average investors, wealthy individuals, bought second, and then finally another dip with the odd lot investors, or the uninformed investors as he called them, buying in at the top before the market corrected. So he saw a three-wave pattern, and that became the basis for technical analysis. Many, many years later, the institutions, banks, and mutual funds wanted to be able to track the market more in depth, and they developed moving average lines, and they used the end-of-day price. So you had two lines. You had the end-of-day price, which was a line indicator, price just showing the end of day, and it moved in a sharp angular up and down, and then a moving average to smooth that price action so that they could determine whether the trend was still intact. Since everything in those days was pretty much long-term except for broker-dealers and banks and others who were short-term selling, only market makers and some traders and some banks were short-term trading, the moving averages were designed for long-term analysis. Today they're still used, and many people try to use them for short-term analysis, and that's a big mistake. Technical analysis became more popular in the 70s when the Market Technician Association started developing a firm platform of what technical analysis meant. It was a group of men who had all worked for sell-side institutions, and they started to develop indicators which they provided as public domain, something that anybody could use because they wanted to make technical analysis popular. In the 50s and 60s, several indicators had been made, stochastics, MACD for the institutions, and then it moved over to the retail crowd later on. Technical analysis had some books written about it, and they started promoting technical analysis as a means to predict the market, which was a huge mistake because it set technical analysis back many, many decades. For a long time, the buy-side institutions, who are fundamentalists, balked at using technical analysis because the original technical analysts promoted it as something where you could predict what the market was going to do. And since the buy-side institutions have been around a long time and they know a lot, they realized that that wasn't possible, that fundamentals have to be part of the basis of it. and that abandoning the rationale of fundamentals for growth in a company and just using price action intraday was a random walk theory, and it didn't work. But recently, fundamentalists have begun to realize that yes, a technical analyst does give you information, and it does tell you a lot what's going on, probably more so now because the market is so much more diverse. It's not Wall Street versus Main Street, as I've mentioned many times. There's 9 primary market participant groups, and all of them have different agendas, different venues, and so on. So how they buy and sell is totally different from one another. And as you learn stock charts and you learn candlesticks, you will start to see patterns. Recently, I created the relational technical analysis, which is my theory on the evolution of technical analysis. When we first had stock charts available, the first thing that was available was only price. Later, volume became available, and then later, more and more indicators. So over time, technical analysis has evolved. The candlesticks were introduced in the 90s by Steve Neeson. So that changed everything, because before that it was either a line price chart or a bar price chart. And bar price charts were extremely hard to read. Also, some people did point and figure, but it never caught on because, again, it was trying to be a predictive tool, and it wasn't. So very few people use point and figure charts. Most people use bar charts for several decades. And then suddenly in the 90s, when candlesticks became available, they burst onto the scene and became hugely popular, and now everyone pretty much uses candlestick charts for short-term to intermediate-term analysis. Candlesticks are beneficial, but you have to remember that the original candlesticks were written for the Japanese rice commodity exchange of the 1600s, so several centuries ago, and it was a commodities market, and there were a few big rice commodities traders and buyers and sellers. There's a huge difference between commodity trading and stock trading. Commodities are something where you buy a futures contract and you're buying a future amount of something of which you are going to take possession and then create something out of or sell yourself. Stock trading is totally different. Company IPOs, they offer their shares out, the underwriter pays them so much for those shares, the underwriter takes it to market, they sell it, they make some money. Preferred clients also can get in early and make money. As the stock is IPO'd, a lot of uninformed investors will buy it, moving the stock up sharply, and then it will decline. But short-term trading and long-term investing are different than commodities markets because you're dealing with a business, not rice or sugar or coffee or soybean, where there's a massive fluctuation every year and it's actually taking possession of a real commodity. A stock is usually held in street name nowadays. You rarely get certificates anymore. In fact, some companies don't even have certificates. So stocks traded are your trading on the short-term fluctuations of price action. That alters how the candlesticks will appear, what candlesticks you should use. The original Japanese candlestick books had reversal and continuation patterns. They didn't have buy entry signals. What we teach at TechniTrader are the new buy entry signals, and that's part of the relational technical analysis. Who creates that pattern of candles, and which market participant is that? What footprint is that? And then that tells you how price will move next, because you understand that market participants group, how they trade, the order types they have, the intent of the trade, the venues they use, how long it takes them to fill their order, how large their lots are, how frequently they buy, and that type of thing. So there's all kinds of factors. By doing relational analysis and saying, okay, this is the footprint of a dark pool, and I know that after dark pools accumulate, they kind of leak out the information that they have been accumulating. They've been keeping the stock price low and in a very tight price range. And now pro traders will come in, and then HFTs will follow, and then smaller funds will follow, and retail traders will follow that. So this is analysis that goes beyond the technical analysis that you've learned. Most of you have learned wedges and trends and that type of thing, but going beyond that is the evolution of technical analysis, and that's where we are right now, because we're incorporating more and more data into the chart. You can have line fundamental indicators, which are very exciting to the fundamentalists, because now they can look at prior quarters and see what's been going on with fundamentals in a line chart right on the chart, which is hugely beneficial to them. They don't have to look up fundamental data. They can look at it on the chart, which speeds up the process. You have quantitative analysis, which you can incorporate into all kinds of things like scans and sorts, and how you approach the analysis also. And you have risk analysis incorporated in a whole new way than you used to. Most people who've been trading for a while, especially those who started in the 90s and 2000s, you're trying to use a percentage stop loss. Big mistake. Big, gigantic mistake, because you may be right putting your stop loss at 8 or 10% right smack in the middle of where pro traders are active, either buying or selling. You have to understand how the pro traders trade, where they trade in the trend, and so on and so forth. You also have to understand HFTs, because a lot of times retail traders are chasing HFT action. Well, HFT action is normally a one-day action. So there's a lot of factors that are going on, and so I've created this course, Relational Technical Analysis. It is for more advanced students who have had at least 5 years of live market experience, who have already taken technical analysis, who already understand basics of candlesticks, who have some understanding of indicators and that, so on and so forth. Now you take it to a whole new level, a whole new awareness and understanding, and the more you understand, the better your trading is going to be, the fewer mistakes you're going to make, and the less risk you're going to have. You're going to have higher profitability because you're going to be trading with a market participant group you fully understand and know how they trade and what they're going to do and their intent. And you're going to have a lot more flexibility in your decisions, and you're also going to be able to see the setups before the stock moves. A lot of times retail traders who've been trading the market for a lot of years are just chasing stocks. The run is already underway, they see it running, they can't stop themselves, they just buy, and then they have a whipsaw trade, and then they get all angry and frustrated. Oh, the market makers are cheating us. No, the market makers are computers. They're not human beings, and they're not tracking your itty-bitty 100 to 1,000 share lot situation. They're paying attention to much larger lots. Plus, your retail broker fills all your orders. 95% or more of all the orders ever sent to any retail broker are filled out of his inventory, unless you're trading a really oddball stock or selling short in which he doesn't have the shares to loan you. And those are the two variables. So what you need to understand is, if you're brand new to the market, there's some basic technical analysis you need to learn. And we have a special course just for beginners that shows all the basics that are modern and current for this market, that gives you a basic foundation of buy entry, sell entry, risk, support, and resistance, and so on and so forth. If you're more advanced, then you need the more sophisticated relational technical analysis, because a lot of you who are more advanced want to make really good money out of the market. You're not just looking for a couple $1,000s a month, you're looking for much more, 10, 15, whatever. And so you need more information to understand what's going on, rather than just knee-jerk trigger reaction because you see something that you think might move up, and so you get all excited and buy it. You have to really understand the market. The market's more complex than it was in the 90s. It's more complex than it was in the 2000s. So you have to treat it with respect and learn to understand what's going on, rather than just listening to retail news, tweets, and twits and assume that you're going to have a lot of profit. Sure, if you're lucky and it's speculative and you're a beginner, you might have some luck in the beginning, but sooner or later, because you don't have enough knowledge, you'll get whacked. And you'll lose a lot of money, and then you'll be either very upset and stop trading altogether and give up, or you'll be frustrated and try to trade again and again and again, and you'll lose even more money, and you'll become obsessive compulsive. You can avoid all of these bad habits, and you can avoid all of the huge losses and everything if you learn to trade properly. Technical analysis is one part of the trading process. TechniTrader teaches a complete trading process, not just a trading strategy like so many people do. A trading strategy is not a process. It's one part of the process. Trading system is one part of a trading process. The trading process is the entire pie. It's everything you need. It's every piece that you need to be consistently successful. Come visit our website. Take a look at some of our stock market courses. We have courses for brand new beginners, the walk around the market, to the elite course, and they are variable and we customize to your needs, so you won't have to relearn things that you already know, and you can apply everything you know to your trading process. That's our goal, is to take everything that you've already learned and apply it to your trading process that you learn from TechniTrader. I'm Martha Stokes, and that's our radio show for this week.
There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders. and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.